Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
I am going to need a new wall calendar very soon, which means it's time for the Wealth is in the Details to tackle a pesky issue. I'm Patrice Sikora with your host, Peter Raskin. And Peter, it is that time of year. The clock is ticking, days are getting shorter and cooler. It is hard to believe that Thanksgiving and Christmas are just around the corner. But from a financial perspective, we have less than 2 months to do tax planning. So what should our listeners be thinking about?
Yeah, it's really hard to believe how quickly the year comes and passes us.
Yeah.
It's just incredible. and probably by the time people are actually going to be listening to this, it'll be probably closer to December. So, you know, I've talked about tax planning in previous podcasts, and I want to stress once again that tax planning is a year-round process that ideally starts in January, not November and December. But nonetheless, we're here, and I think the end of the year is a good reminder to make an assessment, to see how the year played out and make any adjustments that can make a difference.
Well, this is a big, complicated topic because you say it's not just a 2-month process. This is an annual thing. So how do you want to frame this discussion? Because there is a lot.
Yeah, and because of that, we just can't go through every single planning strategy available to all listeners at all times. We just can't do it. So, but I'd like to just kind of hone in on a few, really 5 considerations that are what I think are the most powerful, impactful over a longer period of time, not just one tax year, but impactful over many years.
All right, then let's start with number 1. We'll do all 5, but number 1, tax bracket planning.
Yeah, this sounds really boring, doesn't it? But I think it. But I think it's really a great starting place. So whenever we start planning engagement with our clients, one of the first things I want to know is what's their marginal tax bracket. And when I ask clients that, if I do, they don't know what I'm talking about most of the time. So I find the most helpful document for me is to review their most recent federal tax return. Mm-hmm. And it gives me a lot of good information. What it's important for our clients to understand is that tax rates are tiered, meaning the tax due on the first $22,000 is 10%. That's if you're married filing jointly. But the tax due on income from $22,000 to $89,450 is taxed at 12%. And the tax due on taxable income from $89,000 to $190,750 is taxed at 22%.
Do I sense a pattern here?
Yeah, there's a pattern. And these tax brackets continue to go up. There's 24%, there's 32%, there's 35%. And for joint income over $693,000, it's taxed at 37%. You know, I say, should everyone have that problem?
Really? Really?
But and beyond that, there are additional taxes that may affect us. So, for example, many of our clients with income over $200,000 for a single taxpayer and $250,000 for married taxpayers are subject to an additional tax on net investment income. That tax is at 3.8%. So it's kind of piling on, right?
Yeah.
For those clients on Medicare, they may be subject to an additional surcharge on their Medicare premiums. It's called the IRMA premium, IRMA. It's an income adjustment to their premium. And this surcharge increases their Medicare premiums if their joint modified adjusted gross income exceeds $194,000. So it kind of piles on. It creeps up on you. these tax brackets. So, and I just want to point out that there's a tax guide on our website at raskinplanning.com in the resource center, which people can refer to. And I think it's a good thing to just keep on your desk. And, for whenever you're thinking about how much you pay in tax, think about those marginal tax brackets.
And you mentioned, the one thing you did mention in here too, single versus married taxpayer. Not only are things creeping up on you literally because you're taxed here, you're taxed there, but it depends on how you file.
Exactly. Yeah. Yeah. If you're married, you could file as two single individuals.
Yeah.
And so it's really complicated. The accounting, the accountants will do that analysis and determine what's the best filing for a family, because it does depend. So I think once you understand what tax brackets are all about, then I think you can see how important it is to project what your taxable income might be. And it gives you a lot of insight. So that's a part of our conversation with clients is, what do you think your future taxable income will be? Sometimes it's a guess, but sometimes it's a reasoned approach. We have a good sense of what that might be, and we're trying to understand what are they on the threshold of a tax bracket? If one more dollar will bring them into an additional cost for their Medicare premiums, we want to know that. So we want to consider strategies that can defer income or maybe accelerate deductions, and strategies to manage capital gains and losses to keep you maybe in that lower tax bracket if you're within margins. And so it's just vital to know what those deductions are. So there's a lot here that people need to think about. There's each of us has available to us the federal standard deduction. And in 2023, for a single person, that's $13,850. And if you're married, filing jointly is $27,700. And here's the issue. If you hit the state and local tax limitation of $10,000, that means you can't deduct any more than $10,000 if you've got state income taxes and state, for example, and city property taxes, for example. Right. If that totals $10,000 or more, and you don't have and if your mortgage interest and your charitable deductions and your medical expense deductions, if all of those added up together don't exceed the standard deduction, then you probably can't itemize. You have to use the standard deduction.
Okay.
And this is important as you're making your year-end decisions. So I want to stress something that's really important to me is that we're not having these discussions in a vacuum. We're really bringing in the client's tax advisor. We don't do tax preparation. The accountant that our clients work with really has a real clear understanding and knows the clients, and we want to get their professional tax advice. So I think it's just an important thing I want to stress, that we're in collaboration with our clients' advisors. And I recommend that everyone work with a tax advisor to help them through this process.
And to help them gather all the information. And because you can get it some, but I'll bet you the tax advisor might ask another question, and the client will remember something else that they haven't told you. So you've got to work together.
Exactly.
All right. Roth conversions. We heard about this quite a bit over the last few years. This is on your list of impactful planning considerations too. Why?
Yeah, that's right. Over the years, we've also talked about Roth IRAs and Roth 401k advantages. The big advantages: tax-free accumulation, and no required minimum distributions when someone is now reaching age 73. Those are big advantages. Many of our clients that have significant retirement plan account balances should really be thinking about that. And those clients have two concerns. Those clients that have these big account balances in the retirement plans is that their required minimum distributions during their lifetime and the required minimum distributions over a compressed 10-year time period when their kids inherit their IRAs, those are big issues for clients. And these required distributions are taxable, and they can push taxpayers into a much higher tax bracket. So our clients want to avoid these additional income taxes. And they need to be thoughtful about it and kind of map out how this is going to affect them. So anyone at whatever income can convert traditional IRAs to a Roth IRA. And unfortunately, these conversions have a tax consequence. And the taxable amount of the IRA you're converting is taxable in the year you convert to a Roth IRA.
That could be considerable.
It could be considerable. You don't have to necessarily convert 100% of your taxable IRAs, but it whatever you convert is taxable in that year. Okay. So you want to manage these conversions over a period of years. And here's just an example. If Jane has $1 million in her IRA and she's recently retired at age 60 and doesn't expect to need to take Social Security until age 70, she can convert, let's say, $50,000 per year to her Roth IRA. So over 10 years, that's $500,000 that she can convert. And that additional income that she's converting each year may keep her in a 22% marginal tax bracket. So although it is a cost, she'll have to pay income taxes on that. She's not driving up her taxable tax bracket. Yeah. And that seems like a reasonable current tax cost, which is affordable to Jane in the situation. And here's the advantages that it's got real tax advantages to her husband, and her kids eventually.
Yeah.
So when I talk about impact, I'm talking about not just now. The impact right now is frankly negative for her because she's got to come up with some tax money, but she can afford it. But what's really impactful is 10, 15, and 20 years. And beyond that, for her kids, when they inherit her IRAs, they'll be Roth IRAs and they'll be tax-free to those kids.
And the kids will thank her.
And the kids will thank her. Exactly. Well, I hope they do.
Right. This is true. All right. Well, the end of the year is also a time when many people start thinking about charitable gifts. But our charitable giving, that can have a significant impact on communities. We certainly hope it does. What are the planning opportunities?
Yeah, they're really significant. And I just want to say not all of our listeners are charitably inclined, and that's okay. Mm-hmm. So this conversation is really for those that are charitably inclined, that really want to, give their money to charity. And those opportunities are significant. So the first thing we need to do is think about those standard deductions. If you're not giving enough to charity, you may not exceed the standard deduction. And therefore, the charitable gift isn't going to help you from a tax perspective.
Okay.
So again, let's just, as an example, you've got the $10,000 property tax limitation and state income tax limitation. And if you're giving an additional, let's say, $5,000 a year to charity, and those are the only deductions you have, that totals $15,000 and you're a joint taxpayer, then you're not deducting that $5,000. You're getting the standard deduction of $27,000 anyway. So you've lost, in a sense, that $5,000 deduction. So let's give another example. Jane doesn't usually exceed the standard deduction, but she has $250,000 of a single company stock that was given to her 15 years ago. She inherited it when the stock price was low, but now it's grown a lot. And her basis in this example was $25,000. That means if she sells her stock, she has to pay a big capital gain.
Yeah.
She wants to reduce her risk of owning so much in one company. That's a big concentration of stock. And while she feels good about the company, she just wants to reduce the holding and diversify. If she sells it outright, she'll have to pay significant capital gains tax. But she can gift $50,000 of that stock to a donor advised fund, which is a charitable fund. It's a public charity. And she's able to deduct the full $50,000 as a charitable deduction.
Hi, this is Catherine Broy from the Raskin Planning Group. Apologies for the interruption. Thanks so much for listening to Wealth is in the Details. We hope you're enjoying it so far. If you have any questions or would like to talk more about this topic, please visit our website at www.raskinplanning.com. Look for the podcast's show notes and connect with us via social media.
So then the stock is sold in this tax-free environment, this charitable trust, and it's reinvested in a balanced portfolio. So she's diversified. And then annually, she can request that the fund make distributions to her favorite charitable organizations. So in this example, the gift's will fund at least 5 years worth of charitable giving for Jane's family.
So that's a win-win.
It's a win-win. Now, another advantage is this large charitable gift and tax deduction, because it now might allow her to convert more of her traditional IRA to a Roth IRA, keeping her in a lower tax bracket. So she can do two things at once. She can make a charitable gift that's significant. She gets the charitable deduction, and then maybe she can accept a little bit more income from a Roth conversion.
Okay. Okay. Do you like having these conversations with people about doing good with money? I'm sure they must be really heartwarming.
I love it. I love it, especially with clients that are charitably inclined. It kind of opens up their eyes. And, we start the conversation. A lot of people don't think of themselves as wealthy and don't think of themselves as making large gifts. And then we have these conversations. We talk about the tax advantages. And then I find that that they're giving a lot more than they thought they ever could. And that's inspiring.
That's fantastic. They must really feel so good about what they're doing. And obviously you do too. So what about gifting? What are we discussing here? What's the difference?
Yeah, this is not necessarily tax impactful, but it can be. So I think, gifting or something one you should consider at the end of the year. Gifting to family members, for example, children.
Okay.
Yep. And so in this case, the federal government allows an individual to gift up to $17,000 per person per year. And we call that the annual exclusion gift. If someone gives more than $17,000 per year to a donee, there's a simple information form, a gifting form that should be filed with the IRS each year. But there's not necessarily a tax due on that gift to anyone. And in 2023, for clients giving less than almost $13 million, there isn't a tax due. So a lot of people can make gifts to others. Under current law, this annual gifting limitation is that 13 million, and it's scheduled to reduce to $6,500,000 per person in 2026. So just some considerations. Not all of our listeners have those kind of assets, but some do. And if you're approaching these limitations, gift and tax planning is really vital, and you need to have conversations with your financial, tax, and legal professionals. That's what we do, but you definitely want to have those conversations. But for many of our listeners, they're not approaching these limitations, and therefore the annual exclusion is something that they should consider. By keeping it under $17,000, they avoid the tax that tax filing return. And so I think that's an important consideration.
Right. But why gift though? I mean, you could do it willy-nilly if you wanted to.
Yeah, you can. But I think to have a planned giving strategy can be powerful a powerful way to transfer wealth and opportunities to another generation. Here I'm thinking of investing in 529 plans, education plans to help kids and grandkids really, get advanced degrees. And to me, advanced degrees are a fantastic investment. You can use it to help them buy homes. For a single $17,000 not going to help buy that much of a home these days. But if you're gifting over many years, and that's the goal, is to gift so that the child can eventually purchase, make a significant down payment, that's impactful.
Mm-hmm.
Helping them fund Roth IRAs and 401k plans. I've had clients who help them buy long-term care insurance.
Oh, that's an interesting one.
Yeah, I mean,
very smart one. Very smart.
Yeah, they've got kids that are in their 30s and 40s, and the parents and grandparents say, this is something that is going to help you for your retirement planning. You're in good health now. I'm going to buy it for you. And it's just a wonderful gift, I think. Setting up charitable funds so that the family can gather together once a year and decide how they want to give family wealth away. That's not necessarily helping the family transfer, wealth to a second generation, but it's helping the family stay together and deal and work on values that they all can agree on.
Mm-hmm.
So there's lots of these estate and gifting strategies that can make transfers really efficient and powerful. We don't have time to talk about all those today, but I wanted to mention it as an important consideration for families.
All right. Well, the last item on your list is realized capital gain and loss, the plan that goes into this. Talk to me about this.
Yeah, I think it's underutilized and underappreciated strategy that really should be implemented each and every year throughout the year. So let me just review again. Long-term capital gains are taxed at a much lower rate than regular income. They're taxed at 0, 15, or 20%. And so that's why we kind of focus on that. And it's important to just understand what a capital gain is. If you're buying an asset for $1 and you sell it for $2, you have a gain. You have a capital gain, and that's taxable. What you need to understand is whether it's a short-term gain, which means you've held that asset for less than 12 months. That's short-term. It's long-term if you've held that asset for 12 months or longer. And so we want long-term capital gains because those are taxed at a lower bracket than short-term gains. Short-term gains are taxed as regular income. So a lot there, but it's important to understand the difference in short-term and long-term.
Okay, those are all gains, though. Where we talk about losses.
Yeah, well, losses are on the flip side of gains. If you're investing in something, it's likely we're not hoping for this, but it's possibility that your investment doesn't pay off, and maybe your dollar becomes 50 cents or 80 cents. That's a loss, and it could be a short-term loss, meaning you've held the asset for less than 12 months and you've sold it at a loss, or it could be a long-term loss, and you're selling it for. You've held it for longer than 12 months and you still sell it for a loss. But the advantage of losses is that those losses can be used to offset gains. So if you have a portfolio of, let's say, 25 or 30 or 40 or 50 stocks or bonds, some of them may have capital gains. Some of them may have losses. I mean, it's likely that 1, 2, 5, 10 have losses in any given year. It's just what to expect. Those losses can be used to offset gains. They can also be used to offset up to $3,000. Those losses can be used to offset up to $3,000 of regular income. So you can, if you buy a stock, sell it for a loss. Let's say you have a loss of $3,000. That loss can be used to offset your income, your regular income. And if you're in a high tax bracket, let's say a 35% marginal tax bracket, that could save you almost, $1,000 per year in taxes.
Yeah.
Now, for that's not a lot but if you do it over and over again over the years, that adds up. The other advantage of losses is that you don't lose them. They get carried forward every year. So let's say instead of $3,000 of losses, you have $5,000 of losses. You can use $3,000 in year one to offset regular income. And then the following year, you can use that additional $2,000 of losses to offset income in that next year. So in a way, you're turning lemons, which are losses, into lemonade.
Yeah.
So, but this needs to be done on an ongoing process throughout the year. It can certainly be looked at the end of the year, but I find it very powerful if you're doing this throughout the year, because throughout the year, stocks and bonds have losses. They may recover some of those losses, but maybe you take advantage of them midpoint of the year.
And as you say, this is an annual ongoing thing too. If you're going to use $3,000 to offset in one year, you still have that $2,000 in the second year. You have to be looking forward to this and understanding where you're going to use it.
Right. Exactly. Yep. It can be very powerful and can really enhance your portfolio returns if you're taking advantage of it over time.
Right.
Another thing to think about are mutual funds. A lot of our clients hold mutual funds, and mutual funds are a great way to invest. You're able to buy a diversified portfolio of stocks and bonds. One tax problem with mutual funds is they must distribute their realized capital gains annually. Mm-hmm. And many clients aren't expecting those distributions. Matter of fact, even if the mutual fund is worth less at the end of the year, you still might have capital gains because the mutual fund may have sold stocks that are held in the fund for losses. For gains during the year.
Right. Yeah. Okay.
Yeah. And so you may have capital gain distributions that are taxable even in years where your portfolio went down.
And you're not going to know that until they report that. So how do you deal with that? How do you?
Yeah, that we're actually many of the mutual fund companies are making estimates now. Kind of at the beginning of November, mid-November, they're estimates that we don't know for certain what they'll be, but they're estimates what those realized capital gain distributions will be. So there's a way to, you won't know until the end of the year. But the recommendations there are to, especially if you've got losses in your mutual fund, you may want to sell those shares before the dividends are actually distributed.
Distributed, right.
Yeah, and then you can take advantage of the loss of the fund, and you're not going to be taxed on the distribution. If you wait until the capital gains are distributed, then you're not only paying tax, you're paying tax on those capital gains.
Got it. A lot of moving parts here, Peter. So many moving parts. I think we have to keep talking about year-end tax planning, but as you mentioned earlier on at the very beginning of this podcast, this is not an end-of-year thing, really. We've got to start the conversation again early in 2024. So let's do that. Don't wait until year-end. Folks out there, you got to listen to Peter.
I think it's a good idea. We'll do a tax planning podcast toward the beginning of the year.
I love it. All right. So, Peter, how can listeners reach you? Because I know there are going to be questions.
Yeah, probably the best place to reach us is through our website. It's got our contact information. That's raskinplanning.com. I think that's helpful. Then also they can find that tax guide under the resource section.
All right, excellent. Well, if you haven't already, follow Peter and the Wealth is in the Details podcast for the latest episodes and, of course, insights. And there were a lot in this episode. Also, share with those you care about. And thanks for being with us.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corp. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corp., a broker-dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln Affiliates and other fine companies. Raskin Planning Group is a marketing name for registered representatives of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.